Nifty has fallen by 1700 points since January 2nd, 2026, when it was at its peak around 26,000 points. And right now it is 24,000 points, nearly 9% fall, or in other words, drawdown of 10%. It's a small drawdown, but if this continues, if the escalation continues, it can even become 20, 30, 40%. Who knows how much? Are you prepared? What are your emotions right now? Will you stop investing? Will you invest more? Yes, we will see all that in today's video. What are the emotions that people go through? I'm going to show you data of all the major drawdowns in the last 20 years. And what has happened after that? What if you had invested in each of those drawdowns? What would be your returns? Yes, we'll see all that in today's video, and what action should you take. With all your emotions, what you can do. Nifty, in the last 20 years, Nifty in every calendar year has given positive returns, except for 3 years in 20 years. And so if this year also Nifty returns positive returns in the calendar year, and if you were to invest today, what would be your returns? And that's what we will see in today's video. Hello, I'm Franky. I'm Franky Fernandes. I'm the founder of Harmony and Money. It's a community for families where they learn how to invest, cultivate good habits, and do it together as a team. Because there is a lot of energy and power when a couple works together. And that's what this community is all about. You can find more details in the description and the website. Please do check out the website. I'm also a certified financial planner, and I'm also a certified family and marriage coach. I'm author of 3 books. And so let's now get into today's video. So we'll first look at major drawdowns in the last 20 years. That means starting 2006 to 2026. What are the major drawdowns? Drawdowns are when the market falls from the peak. Whatever is the peak, when it falls, that measurement, that percentage is called the drawdown. That means the market has fallen from the peak. And there have been huge drawdowns in the last 20-year history. Right now, we are also seeing a mild drawdown because of the Iran and Israel-US war, probably 7 to 10% from the peak. Probably from the peak, it is now 10%. And we have had even more in the last couple of years. But the ones that we're going to talk about are the major drawdowns, which actually really affected markets, sentiments, investors, money. Let's take a look. So here we have the phase since 2006. The first one is the global financial crisis. The drawdown was approximately 60 to 65%, which means if the markets were 100, they've come down to 35 to 40. Huge drawdown. And it took 5 to 6 years to come back. And the message is the deepest fall, but investors who held and added were strongly rewarded. Now it is easier said than done is to invest. Invest when the market goes down. Invest, it's a buying opportunity. But trust me, I've gone through that. I have seen that 2008 and 2009 crisis, let alone investing. We were worried about our jobs. It was a very gloomy period, extremely gloomy period. And I remember I was moved from one team to the other. And in that team, the first thing I had to do was fire. It was a very painful thing. And in that time, I still remember when the market had gone down to 8,000. And we were talking about investing, but nobody had the guts to invest because we don't know how more it will fall and when it will come back. But all those who invested during that time have been handsomely rewarded. And I'm going to show you in the next slide what was the reward. Yes, as I said, it is easier said than done, but you can't actually invest. The 2011 crisis, 20% drawdown, and it took around 2 years for it to come back. And here the lesson was not every big fall is like 2008. Stick to asset allocation. Then 2015-16, 25% drawdown, and it took 1.5 years to come back. And the message was mid-cycle corrections are normal, not a reason to exit India. And this has happened several times. Then 2020 COVID crash, 38 to 40%. Yes, this was a huge crash, which we all have seen in this generation has seen this. But it took 8 months to come back.
Fastest crash and recovery prove that timing re-entry is impossible. And finally, during the Ukraine-Russia war, when it began in 2022, the drawdown was 10-15%, and it took 5 months to come back. Many crashes are just healthy corrections in hindsight. This was the key message. Now, during this time, it is very impossible. It is difficult to invest, especially if you've never seen drawdowns. You'll be afraid. There'll be fear. We'll talk about some of those emotions a little later. So what if an investor had invested every fall, every crash, invested a lakh rupees? What would it be today? Let's take a look at it. So 2008, the market was around 2,755. Today, the level is around 24,450. So if you had invested a lakh, it would be 9 times today. Yes, I know it is almost 20 years or 18 years, but still 9 times is a big number. December 2011, today you would be having 5.5 times returns, 5.29. February 2016, 3.58 lakhs, 1 lakh turning 3.58, it is like 3.6 times. COVID, 3.26 lakhs, that is 3.3 times. And actually, what we are seeing here is the index, Nifty. But I had also invested in stocks. When I look at those stocks which I purchased during that time, it's in a separate account. I have got 4 times. When I look at it, is 4 to 5 times it has gone up. And this is very true. And June 2022, if you'd invested, it would be 1.6 times. Now, why is this that markets still give you very good returns? Of course, the number one thing is that the market is at so low. If you see the base, 2,700, 4,600, 6,800, 7,500, 15, 183. But today it is 24,000. So this is one reason the market is always going up. Despite all those drawdowns that we talk about, the market keeps going up. Another way of looking at it is, let's take a look at it in a different perspective. Now, these are the Nifty returns from 2006. So every year, this is a calendar year return. 40% returns, 55% returns. Now here it is negative, right? Around 50%, 2008. But in that calendar year, the next calendar year, 75%, 18%. Here it is negative. Then 27%, 6%, 31%, -4. Rest all the times here, it is positive. That means in 20 years, 17 times calendar year returns is positive. Yes, from 2000, around 3,000, the market is now 24,000. Regardless of those drawdowns, whatever happens, those who take the courage and invest will reap rewards. But that is not what it happens. It's easier said than done, right? All those who have seen the markets, also the drawdowns in the recent past, know that the market comes back. But still, everybody is afraid. Everybody fears. And you know what happens during this time? Let's take a look at what happens during this in Indian markets. What Indian data shows. Very interesting. During COVID crash, March 2020, there was actually a net inflow of about 11,700 crores in March 2020. Market had crashed 30%, drawdown of 30%, but still everybody was investing, was not worried. But April 2020, the net inflows fell 47%. And what does net inflow mean? Gross inflows means the money coming in, the mutual funds, and there are redemptions happening. So this plus and this minus makes it the net flows. Now the net flows fell by 47%, which means maybe the money that is coming has fallen, or maybe the money that is going out has gone up. That means redemptions could have been more. And if you see month on month, March, it was 11,700. April, it became 6,200, the net inflows. But of course, there were no mass redemptions. But when you compare the SIPs, panic was clearer in the behavior around SIPs. SIP collection in 21 fell about 4% compared to FY20. That means either the SIPs were stopped or they were paused. In fact, the next point shows it. SIP stoppage ratio spiked to nearly 60%. That means the SIP cancellations and pauses were high relative to new registrations. A strong sign of retail fear. There is always that transition that happens. Initially, yes, let's invest. This is a buying opportunity. I'm sure you would have felt it in the last couple of weeks. So what if the war happens? This buying opportunity. But in the last few days, every session we are losing 1,000, 2,000 points. Now, this is where the rubber meets the road. This is where is the true test of your risk profile. This is where panic begins. Now, what are the emotions that people go through? Why, despite seeing the history, why is it that we still cannot be bold and courageous and invest? I wonder what you are going through right now. But let's take a look at what are the feelings that investors go through. The biggest emotion that we all go through when this happens is a shock, anxiety. How can the markets crash so much? There's an anxiety. You have invested all your hard earned money, and what's happening to that money? You feel bad. You feel hurt. You have a strong urge to do something to stop the pain. But, friends, this is the price we pay for investing in equities. This is for the price for the returns that we will get one day. This is the true test of your risk profile. Have you done your risk profile off late? Do it today. You will know what is your how you process all this. That's why we are not able to invest, even though it's a great opportunity. Number two, in behavioral science, there's something called loss aversion. And this is what we all go through. Loss aversion basically says that 1 unit of negative is far more potent and powerful than 1 unit of positive. Which means if the market goes up by 1,000 points, the joy that you get, the pleasure that you feel is much less compared to 1,000 points falling. That means 1,000 points falling is like 4 units. 1,000 points going up is like 1 unit. So the pain is far more than the joy. And that's why investing is not easy. You can't naturally invest unless you have seen the market for several years. Even those people are cautious. So that's why many don't invest. Despite all the data that I've shared with you, you should ideally go and invest. By the way, I have invested. I've been investing even during this time. I've actually moved money also from my debt funds into my equity funds because I've seen the markets. But not everybody can do it. But this is the right time to invest. If you take that courage, if you have cash, which you don't need for the next 5 years, right time to invest. And as people see the news, watch the news, hear videos of attacks, Iran and Israel and all that, that actually plays in your mind. And there is a sense of fear and panic and hopelessness. Yes, if you are in Iran, it doesn't make sense. This video doesn't make sense because you are running for your life. Because what is the point of investing when you will not live? And that is true with us. If you feel it is hopeless situation, then it doesn't make sense because anyway you will not survive to see your money. But that is not the case with us. We've seen several wars around us. Even Indian wars. In my last video, I've shared about what happened during those Indian wars. Yes, there were drawdowns, but then we have recovered. So during this time, the emotions are low. And this time, with all these emotions, when you see others, your friends and others selling and saying, hey, we don't know how the market is, what you feel is that maybe they know what I don't know. But that is all false. All false. And the typical action which people take out of fear and anxieties and panic is number one, you stop your SIPs. You don't process your SIPs or you don't make new investments. You just stop. But the worst is there are people who stop their SIPs and withdraw their money. I think that is the worst when you withdraw your money because you're withdrawing at a loss. But the fear and the anxiety is so high that you worry. And this is a time when you need a coach, an advisor who can help you. So if you're having these emotions, right, you cannot control yourself. You're worried, you're fear. Go to an advisor, go to an expert, talk to them because this is the best time. I have had many of them coming to me. And in fact, my clients, I tell them in advance, don't panic. Even this too shall pass. Because this is the time. In fact, your advisor's role now is to actually understand your psychology. and help you. So go to an advisor. If you are directly investing and you're making your own decisions, you're more likely to withdraw or stop investing, because whatever you may think, whatever you may have read, you will panic, you'll be worried. But this is a time when you have to do exactly the opposite. So go talk to your advisor. And you know something, during such times, the biggest damage is not what causes is not your intelligence, it is your emotions, it is your behaviors. And we honestly don't know how long the market is going to fall, keep falling. If you have money, this is one strategy that you can use, which I have used many times. If you have a lakh and you want to invest in this market, don't put all 1 lakh in one day. Divide it into 4 or 6 parts and keep investing as the market falls. And what if the market goes up? You have got the bottom, right? You invested at the bottom. And after then the market goes up, you can keep investing because the market has fallen probably by 10%. And when you invested when it was the bottom, when it goes up, you are still investing. When it goes up, probably you can still, but you still are not at the peak. So you will still gain. So what we'll do now is we'll take a look at what happens in this fall, which is 7-10%. Probably it goes down by 15%. And when it goes up to that same level, probably this year or even next year, what kind of returns you will receive. Let's take a quick look at that and we conclude. So the year ended the Nifty at 24,450. So let's assume that is the start point. And right now the market has fallen and it is roughly around 24,000, right? 450 points down compared to the start of the year. So now if you invest, and by the year end, market, the Nifty calendar returns are, let's assume 5%, 10%, or 15%, 3 scenarios. What if, just like previous years, which I showed you, that Nifty always gave positive returns 17 times in 20 years, it is give positive. Just assume that it gives positive returns of 5% from the year start. What will be your returns? Let's take a look. So if you invest 1 lakh in March 2026, the scenario, and just assume that from December 31st till 31st December 2026, it's 5%. Your approximate returns will be 7%, right? Not negative. It will be 7%. And if the returns are 10%, your returns will be 12% more. That means you'll get 1,12,000. That you'll get 12,000 more. And what if the year ends at 15% Nifty? And is it a possibility? This is hypothetical discussion, but is there a possibility that the year end can be positive? Could be, because almost every year Nifty has given positive returns calendar year, and probably they'll be positive. And even if 5% positive, you get 2% extra if you invest right now. Yes, but the question is, will you? Yes, this video is basically to help you understand your emotions and what actions you should not take. And if you take action, if you invest now, you will see positive returns probably, if not this year, probably in the next coming years. You will get 2, 3, 5, 10 times 2, because eventually the markets will go up. This is a temporary phase. Yes, but disclaimer, please talk to your advisor and make those decisions. This is just a video for educational purposes, to make you think. I hope there is some understanding you got from this video. If you liked it, please show me a thumbs up. If you haven't subscribed to this channel, please do so that you'll get to learn about all these basic conceptual understanding about investing as a young family. Bye for now, and hope you continue staying invested in the equities market.